Hi, everybody. This is Coach or Dr. Spellman here to talk to you about, well, where do returns come from? So, the title of our section is Bottom Up to GDP to Stock Returns. I'm going to show you how to move from drivers of GDP to determine what creates GDP from a bottom up, starting with population. And then we're going to go all the way to equity returns. And then we're going to be talking about different drivers of equity returns to, look at the equity markets in a little bit more detail. So let's start with GDP. So what are the drivers of GDP? Well, the long-term driver of GDP, a big one, is population. So if there's more people out there consuming and producing, you're going to have more GDP growth. And you can see in the United States, population growth has been slowing over the past 20 or so years. It was about 1%, and it got all the way down to about zero after COVID, and it's starting to come back up. So it's been slowing over time, and that can help explain why our economy has been slowing as far as the growth rate. But that's not the whole story, but this is a big driver in the starting point. So we also have to think about what percent of that population are in the working age, okay? Now, this shows you here that the population grew about, a little bit less than 0.4%, but the working to population age, the ratio has been going up over time. So if this goes up over time, this 0.4% grows to, close to 1% because this popped up. But again, that's not the whole story. But right now, all else equal, the economy should grow at just a little bit less than 1%. Then we have to think about what percent of these people in this working age are actually participating in the workforce. This has actually been going down over time. Maybe as people have gotten older, and then they decide they drop out of the workforce early, or during COVID, remember we had this great resignation. Maybe people started to think about, maybe there's some other things in life besides working. And this just cratered. So right over here, the working population growth was 0.4%, but with this participation rate cratering, the actual labor force growth went all the way down to minus 1.5%. Now it's starting to come back up. Possibly wages are going back up, and that encourages people to come back in the labor force, or it's just inflation is really, really high, so people have to go back in the labor force in order to afford things. But this little rise here, on top of this about 1% growth in the working population growth, led to a labor force growth of 2%. So this is our labor force growing 2%. But again, so all else equal, GDP should go up 2%. But all else isn't equal, then we have to think about what percent of the labor force are actually employed. So if we add the unemployment rate to the labor force, and you can see the unemployment rate went way down here coming out of COVID, the employment growth rate was 4%. So let's go back. The labor force growth rate was 2%. But since more of the labor force was employed as the unemployment rate went down, the employment growth is 4%. So we have 4% more people out there in the workforce. Then we have to think about how many hours are they working. So this is hours growth. You see, it doesn't vary, a ton. Now, during COVID, people worked more. Maybe they worked more because they didn't want to lose their job. But then it dropped coming out, and we're back to about zero. So this is the zero line here. And if our employment growth is 4% and this is going up zero, then that means our hours, basically the employment growth times hours growth, is this 4% is the same as this because that's a zero. Okay, now, so we have basically, the we're growing 4%. Now that's before we consider how productive are these employee hours. And productivity is cyclical, and there's also secular things, and we've talked about this before. But recently, productivity has been just caving, all right? It's down 2%. And because productivity is caving right now, our real GDP growth is slowed to approximately 2%. Because, you know, if it weren't for productivity, we'd be growing 4%. But with the worker hours, making less widgets per worker hour, 2% less, our real GDP is starting to slow. Now, we've talked about productivity before, and we've seen that when you come out of a recession, productivity tends to be pretty high, and then it actually slows over time. So there's a cyclical element, but there's also a secular element. You know, if you invest more in equipment and technology, maybe you become more productive over time. So there's a lot of things that determine this. But right now, it's going against us, and our real GDP is slowing, okay? So if we put all this together, this is the equation for real GDP. It's 1 plus population growth, 1 plus the working to population ratio growth rate, 1 plus how participation rate grows, 1 plus the employment rate growth. Now, keep in mind the employment rate is 1 minus the unemployment rate. So you kind of have to flip things. So let me talk about this. So in 2021, the unemployment rate is 5.4%. So the employment rate was 100% minus 5.4 or 94.6%. 2022, the unemployment rate was 3.6%. This is end of year statistics. So the employment rate was 96.4. So what is the growth in the employment rate? Well, you take the 96.4 to ending divided by the beginning, 94.6, and that rate grew 1.8%. So that's the 1.8% we put in here. Then we put the hours growth rate and the productivity growth rate, and you subtract 1. Why do you subtract 1? Because I added 1 to all these. I have to subtract 1 in the end. If I do all this, and I look at real GDP growth, this is real GDP growth over time. And all these different components are the colors. And you can see here, as I said just a little bit ago, when you come out of recession, productivity is really high. Firms are slowed higher. So that means you're getting way more production output per person. It's only later on as the economy's been strong a little while before, you know, employers start to hire. So you can see this blue productivity tends to be pretty high coming out of recession, high, and then it kind of fades off over time in this high here as well. Productivity as a portion of real GDP growth has been about half, okay? Population growth was 0.8%, productivity is 1.5%. Hours growth, well, this was actually a minus, so it actually took a little bit away. Over this whole period of time, this is going back to 2002, so about 20 years of growth, well, 19 years of growth rate, 20 years of data. But you can see what's most important is productivity and population. Let's look at each one of these variables a little bit more detail, and then we'll get into, starting with real GDP, then we'll go into what is stock returns. So this is nominal GDP. All nominal GDP is, it's 1 plus the real GDP growth times 1 plus the inflation growth. So it's going up over time, up and down. And I have over here a correlation matrix. Let's just look at the nominal GDP growth column. I have a bunch of things over here associated with, you know, the consumer, so consumer confidence, unemployment rate, hourly wage growth. And then I have industrial production and the ISM PMI index, which is, you know, the measures of the manufacturing. So I got consumers here and I got manufacturing. I have something on the dollar and commodity prices. This is Goldman Sachs commodity index, inflation, government spending, just kind of looking at the federal deficit percent of GDP, and some things on monetary policy, Fed funds rate and money supply, M2 growth. So as you would expect, nominal GDP growth is positively correlated with consumer confidence. Well, if they're more confident, their unemployment rate, negative correlated with unemployment rate, they're probably not unemployed. And if they're not unemployed and their wages are going up, they're probably going to spend more. And of course, nominal GDP growth is a function of spending of the economy. So every one of these is exactly what you expect. If you're more confident, you're not unemployed, and you're paid more, you probably spend more. So that's the reason why these correlations are positive and negative to GDP growth. Now, industrial production, this is just the output of the economy, is very positively correlated to GDP growth, which you expect. Economy is strong, you expect more output. Now, the dollar is negative. We're going to get back to this in a few slides here. It turns out when the economy is strong, the dollar is considered a safe haven asset, so it tends to go down, okay? But when the economy is strong, commodity prices tend to be high. Well, economy is strong, demand's high, that drives up commodity prices. And it's also driving up inflation and CPI, excluding food and energy. And if you look here, Fed funds rate is normally going up when the economy is strong because there's more inflationary pressures, and probably the Fed is trying to counteract that by raising interest rates. So that's the normal scheme of things. And this is what it's been for the over this period of time, which approximately lasts 19 years or so. Let's look at each one of these variables well, before I look at the variables, just a note, correlations will change over time with the economy. So just don't think these correlations are stagnant. These are just the changes in the correlation coefficients over the most recent time period versus the whole time period I had on the prior graph. So things do change. So let's look at each one of these trends, starting with the consumer. This is consumer confidence. There's, as we've shown you in prior sessions, there's a bunch of different measures of consumer confidence, but it's gone way up and it's starting to come off, so it's moderating. Now it's moderated and it's gone way up, and it runs inversely with the unemployment rate. So if unemployment rate's high, you expect confidence is going to be low. So confidence dipped here when unemployment rate was really high during COVID. Now unemployment rate's really, really low, and confidence is moderate. So what is driving that? Well, maybe it's high inflation, okay? Over here, you can see that the unemployment rate seems to be inversely related to average hourly earnings growth, and hourly earnings growth is starting to roll over. Even though unemployment rate is still very, very low. Looking at business trends, this is just looking at industrial production. You can see it was really, really high in the US and the OECD coming out of COVID, and it's really moderating here. And we see the same thing with the ISM manufacturing index. And you know all about this because we've talked a lot about this manufacturing index over time. But you can see it's a little bit less than 50, which means the manufacturing sector is starting to contract, and that's highly correlated with the stock market. The goal is just looking at the annual change in this. So the black, you think of as the growth of the manufacturing sector, so it's below 50, so it's slowing, and the goal is it accelerating or decelerating, and it's decelerating very, very quickly right now. So let's look at trade and government. Trade over here, I'm looking at the dollar, which is the black line, it's the annual change in that, and Goldman Sachs Commodity Index. Did you notice these two are very inversely correlated? Now, why? It's almost like perfect. So if the dollar rises, commodity prices go down. If the dollar goes down, commodity prices are going up. So what are the two variables that drive this? I'll just pause just for a few seconds to let you think about this. Why in the world, when the dollar goes down, does commodity prices go up? Okay, and vice versa. Dollar rises and the commodity prices go down. Okay, well, let me give you a couple reasons why this is the case. Most commodities, as they're traded around the world, are traded in dollars. Let's say the dollar goes down. This is the right scale. So dollar is down 10%. Someone outside the US is sitting here thinking about, let's say, buying oil. Well, oil became 10% cheaper to them because oil is priced in dollars. So if the dollar goes down 10% relative to the currency, it's 10% cheaper. Well, what do you do if something's cheaper? You buy more of it. So if the dollar goes down, oil is cheaper to those people outside the US. They have more ability to buy oil, go on vacations or whatever it is. So that drives up the demand for oil, okay? And if the demand for oil is higher, what happens to the price? Well, this is the commodity index, it goes up. So one thing that drives this up and down, this negative correlation is just, frankly, most commodities are traded in the world in dollars. Now, the second thing is if the dollar is weak, a few slides ago, I said, when the economy is strong, the dollar tends to go down because it's a safe haven assets. If the economy is strong, people are not seeking the safe assets and they go into the risky assets and they sell the dollar, okay? So if the dollar is going down, that probably means the economy is strong. If the economy is strong, we'll be using more aluminum and steel to expand manufacturing capacity. Will we be going on more trips? Basically meaning the demand for oil is higher? Yes, the answer is yes. So the demand for commodities goes up when the dollar's weak because the dollar's weak because the economy is strong, and that's pushing up the price. So recently, the dollar had strengthened. Now it's coming off here recently, and commodity prices are going down. You would expect maybe commodity prices to go up here, but there are other things that drive the dollar just besides the strength and weaknesses of the economy, which we'll get into in a later section. So let's look at the Fed funds rate. So this is black is the Fed's funds rate. It's really spiked up here. Of course, that's because the Fed's trying to combat inflation, which is also really rising. Now, earlier in another section, we talked about how M2 growth times velocity of money equals price times quantity. M2 growth, which is the gold line, is slowing significantly. It's actually negative. And you can see it hasn't been negative in any of these cases. It's negative. And what I'm showing you here is M2's growth relationship to the economy proxied by the ISM manufacturing index. It actually leads GDP by just a little bit. But you can see that M2, this rises and the PMI tends to rise a little bit later. So if money supply is increasing, then the economy tends to increase a little bit later, and the money supply slows, the economy slows a little bit later. And we've talked about this, it takes a little while for monetary policy and interest rates to influence the economy. But this huge slowdown here would probably mean that this PMI, which is, been really decelerating, is probably going to continue decelerating. It's also related to prices. So you can see this a little bit. When money supply goes up, prices tend to lag and go up a little bit later. So this huge money supply growth, maybe what contributed to this huge inflation. But it's obviously contracting now, so maybe the inflation starts to roll over. And it is starting to roll over here. All right, now that's the economy. Now what I want to do is take you from the economy to stock returns, okay? So what is the stock return? Well, we start with 1 plus that real GDP growth, and then you got to multiply it by 1 plus the inflation rate. These two things here gets you to nominal GDP growth rate. So we have nominal GDP growth rate times 1 plus the extra growth rate for stocks, we'll get back to this, times 1 minus, now this is very important. If I test you on this, I may give you share growth rate. You need to make sure it's 1 minus share growth rate. If your shares are shrinking, then returns are higher because this is a minus and the shares are shrinking, the growth rate would be negative. So minus a minus is a plus. It makes stock returns higher. It's because you're dividing up your stock worth among future shares, so each share is worth more, okay? So it's 1 minus the share growth rate times 1 plus how much profit margin is growing times 1 plus the change in the PE ratio minus 1, subtracting 1 because all these have the 1 added to it, and then you have to add dividend yield. Now remember, price is just the price to earnings ratio times earnings is P. So PE times E is P. Okay, so all these things together drive, the returns of the stock market. Let's explain this extra growth rate that stocks return above nominal growth, GDP. So I have down here in gold nominal GDP growth rate, and I have the SPX, the S&P 500, its sales growth rate. Okay, this is sales growth rate. This sales growth rate is just these two variables times 1 plus this extra growth rate. Because if you look at this, the S&P 500 tends to be a little bit more volatile than nominal GDP, but it looks like the overall growth rate is just a little bit higher. So the black line, the growth rate is a little bit higher than the gold. Why in the world does the S&P 500 sales grow a little bit quicker than the economy? Now, as you're thinking about that, let me tell you why maybe the economy is less volatile than the overall market. Well, if you think about the economy, part of the economy is government spending. And government spending, as you've learned in the earlier section, has some automatic stabilizers and may run counter-cyclical. So that's part of the reason why nominal GDP growth rate tends to be less volatile than the sales growth rate of the S&P 500. But why does the S&P 500 have a higher growth rate than GDP? All right, so let me give you a few reasons. One is the S&P 500 tends to have sales of not just the US, but other countries. So if you look here, the United States for the S&P 500, this is S&P 500, is only 60.9% of revenue. So that's one reason. And maybe the large companies in the US have more investment in countries that are growing quicker. 7% of the S&P 500 sales comes from China. So another thing is you have to think about what is the makeup of large US companies, S&P 500 versus the overall economy. Well, the S&P 500 has almost 30% in technology, which has historically grown quicker than the overall economy. I mean, how quick is government spending going to grow, which is part of the economy? So technology is been growing quicker, and that's not quite a third of the S&P 500. So you have international sales, you have the sector makeup, but there's other things. So a lot of the companies that make up the economy, they're small private companies, and they really can't give you the productivity growth that big manufacturing operations can. So let's take a barber. What is the growth rate of the barber? Well, can they really become that much more productive year to year? I mean, they're using their hands. Maybe when they, got an electric razor or whatever, or, clippers many years ago, they became more productive and they could cut more hairs. But now, really, they're growth rate of their GDP of a barber shop is probably just inflation, because they don't have, unless they're working more people hours, but they really don't have productivity growth. So this 1 plus is really 1 plus 0 for that one, and they're just getting the growth rate of inflation as far as how much is their GDP from barbers. So there's a lot of private companies that just can't become more productive. And that's going to lead to a lower growth rate of the overall economy than S&P 500. And the last way argument, I'd say why the S&P maybe grows quicker than the economy is simply because they can sell off underperforming businesses and invest in other businesses that may be growing a little quicker. Although they tend to actually sell at the bottom and buy other companies at the top. So I'm not 100% sure if that adds to the growth rate or takes away from it, because corporate managers, unfortunately are more acquisitive when prices are really high of businesses, and they sell off businesses when after times have been bad and kind of at the bottom. So let's go back through this. There's maybe 3 reasons, maybe 4, why this is higher. One is it's not just US, maybe they're invested in international countries with a little bit higher growth rate. 2 is the sector makeup, much more in technology, and technology's been growing quicker than the overall economy. 3 is they have more ways to become productive versus the overall economy, okay, which, some parts of the overall economy just can't become more productive. And a question mark is maybe they buy businesses that have high growth rates, and they shed businesses that have low growth rates, and that can impact their overall sales. But this is a very important equation, and this is the equation for stock returns. So now let's look at what it's been over time for the S&P 500. This is going back to the last, since 2005. So this is the total return on the stocks. And you see this PE growth is really tends to be very volatile. And margins also tends to be very volatile. We'll get to that in the next few slides. But if we look at the total makeup of returns, real GDP growth was 1.8, inflation was a little bit higher, 2.2, dividend yield was 2, so that makes up more than half. The PE ratio has expanded, and so have profit margins. Companies been shrinking by about a little bit less than 1% a year, that's a minus here, and they had higher growth of sales than the overall economy, 1.6% higher. Now, what I like to do is give you a test question, give you a whole bunch of data that's here, and then data that you see here, and I say, what is GDP growth? And then I say to you, based on this data, what is stock returns, okay? So let me give you a little spreadsheet and walk you through all this and help you in what I may give you that could show up on a future test. So I'm not going to hand you this spreadsheet, because if I handed you the spreadsheet, you wouldn't learn how to use it. I'm going to go through here, and you can take snapshots and pictures of the formulas that we're going to walk through, and you can create a spreadsheet yourself, and then you're really going to learn these equations, okay? So all the way on the bottom, I have a return, okay? And I have all these different variables I just walked through with you to get to that return. Let's start with population growth, and let's go all the way to dividend yield and total return. So first of all, let's assume the population starts at time 0 at 337 million, and it goes up to 338.3 million. So we got about 0.4% population growth. Look at the formula. I take the ending divided by the beginning minus 1. I could have done this growth rate as the ending minus the beginning over the beginning, but I like to do it this way because it's just a little bit quicker. So population growth is growing maybe 0.4% a year. The working to population ratio. So what percent of the population is in the working age? Kind of like mid-teens to mid-60s. Well, let's say it started with 79 and went to 79 and a half. So that actually, the growth rate is 79 and a half divided by 79.63%. If I do 1 plus this times 1 plus this, that would give me what the returns are, excluding everything else. Now let's say the participation rate ratio went up. So it was 60% of the working age people were working, or wanted to work, sorry, and it went to 62.2. This has been an upward projection here most recently, in the most recent year. So that's 0.32% growth. 62.2 divided by 62 is 0.32. And then the unemployment rate. Now this one, remember, we have to flip. So the unemployment rate, let's say, starts at 3.6, and I'm assuming the economy is going to get worse. So it goes to 4.6. So what is that rate? I have to do 1 minus the initial rate. So 1 minus 3.6% would be, or 100% minus 3.6. That would be, 96.4% employment rate. And it's going backwards. So it's 1 minus A10. Sorry, I actually did 1 minus A11, the ending, divided by 1 minus the beginning. So 1 minus A10 would be a 96.4, and this would be a 95.4. Yes, 95.4. So 95.4, which is this, divided by the beginning 96.4, gives me an employment growth rate of minus 1%, negating a lot of this positive, okay? Then I say how many hours I work. Well, I start with 40, all right, 40.0, and I go to 40.4. So I'm making my people work a little bit more, so my hours growth is 1%. And let's assume they're not going to be more productive because we're later in the cycle at the moment, and we know productivity slows. So what is GDP growth? It's real GDP growth, that is. Well, I take 1 plus this growth rate, 1 plus this growth rate, times 1, 1 plus this growth rate, 1 plus this growth rate, which is negative, 1 plus this growth rate, 1 plus this growth rate, and I subtract out 1. My real GDP growth forecast is 1.3%. That's exactly what I was doing on this slide, okay? And you can see I subtracted 1 at the end. Now, I got inflation. So let's go back to my next slide. Let's go up a few. I have to add 1 plus the inflation rate, and I need to do all these others, okay? So 1 plus the inflation rate onto 1 plus this gives me nominal GDP growth. So again, look at this. It's 1 plus the real GDP growth times 1 plus inflation gives me 6.4% nominal GDP growth. And then I have to do all my adjustments for stocks. So I'm going to assume my S&P 500, its sales growth rate grows about 1% more than nominal GDP growth. I'm assuming I'm shrinking my number of shares, okay? And my profit margin, which tends to be pretty high right now, I'm assuming it's going to go down. So if it's going down, it's going to 10 from 12. That is a drop in a growth rate of profit margin of 16.7%. It's the main reason why my returns and are down here. Now I'm also assuming my PE ratio is going to be going down from 18 to 16. We'll be talking about what drives PE ratio in a little bit. If 18 goes to 16, that's a drop of 16 divided by the starting 18, 11%. So how do I get this price return? Well, I start with the nominal GDP growth, 1 plus nominal GDP. I add in my extra growth rate for sales. And then my sales per share, you remember, is 1 minus the share growth rate. So if I'm shrinking my shares, is a 1 minus 1% growth rate. We're buying back some shares. That actually adds up to a positive to returns. But my profit margin on those sales are falling. So my earnings per share is falling, all right? And then my PE ratio is going down. You know, E times PE is price. So my price return is about minus 20%. Remember, don't forget to do the -1 here. So once I'm done with this, I just add dividend yield. So this is a straight adding. I start with the price return and I add dividend yield and it gets to minus 17.6%. Now, what I would do if I were you, if I was preparing for a test, I could ask you what is real GDP growth. I could give you real GDP growth and I could give you inflation. And say, what is nominal GDP growth? I could give you any one of these combinations and ask you for the others. I would make sure to have a spreadsheet where all this is programmed in. They get using the same numbers as me, they get to this minus 17.6. So you know if I give you some new data, you'll be able to get the answer right. And again, why do I not give you the spreadsheet? Because if I just hand you the spreadsheet, you won't really understand how the formulas work together. And my goal is to make sure you actually learn this stuff versus just be able to plug a number into a spreadsheet. Okay. So this is stock returns, and we know stock returns is a function of nominal GDP growth rate and then all these other things. What I would like to do is talk about PE, talk about margins, because it's sales times profit margin that gets you to earnings. So I want to really hone in on what's driving PE and what's driving margins along with sales. And because it's PE times E, PE times E is price, okay? So E is slowing. So I have a model, and the model is this EE index, all right? And this model leads actual earnings, this is trailing 12 months earnings growth, by about 8 months. Now this model is proprietary, so I'm not going to tell you the weights and things like this, but this model leads actual earnings. And right now, the current reading says earnings, which is the gold, are set to slow to negative. So what's in the model? Interest rates. Now, if interest rates go up, you would expect that it eventually slow the economy. If a business outlook survey, if businesses are kind of negative, then they're probably not going to expand. If they're not going to expand, that's not going to result in capital spending and sales for another company. And if they're not expanding, that could result in lower employment growth. And if there's lower employment growth, of course, people have less money to spend. So I have some things on capital spending and inventories. I also have loans. And loans tends to be cyclical. If less people are borrowing or corporations are borrowing, they may borrow to spend. So if there's less borrowing, there'll be less spending. And of course, if there's less spending, there's less earnings. And I have something on the dollar and CPI as well. And we know the dollar is inversely correlated with GDP. So and I have CPI, so I have inflation in here. If inflation is really high, of course, then the Fed's probably going to be working to slow the economy, and that will impact earnings. So you can see that the black line has been coming way off, and it leads to gold, so you would expect earnings to be slowing, and it is, but now maybe actually going to a negative. Now, does this matter? Yes, stock returns, which is the black line, tend to have about a 6-month lead to earnings. So, and stock returns are negative, which means they're probably pricing in negative earnings growth. So kind of right on schedule. So earnings is slowing. It's a major component of prices, okay? But PE is also very, very important. So let's look at earnings a little bit more. Let's look at profit margins. Net income tends to be more volatile than sales. So what I have on the bottom in the gold is net income growth for the S&P 500. That's what SPX is. And I have sales growth, okay? So you can see that income goes up and down a lot more than sales growth. And I have a question here, why? We'll get to profit margins going up over time in a little bit. But let's first of all talk about why is income so volatile relative to sales? What is that? Well, here's the answer. Sales can go up and down, but not all your costs go up and down. You may have what's called operating leverage. So let's go look at that. Let's say at time 0, sales are 100. And let's say at time 1, they go to 102. So they're up 2%. Okay. You have costs. Some costs are fixed and some are variable. Variable ones are like, well, you make more widgets and you need more materials to make the widget. So variable ones go up and down with sales. They're variable with sales. So let's say variable costs are 60. And in order to make more sales, you need more supplies in order to make whatever the product is. And that goes up 2%. So the 60 goes up to 61.2. But you have some costs that are fixed, and that's 30. So 100 minus the 30 fixed cost minus the 60 variable, you start with earnings of 10. About 10%, which is a little bit lower than the current profit margin of the S&P 500, okay? So 10 of 100 is 10%. So let's say, but these are fixed, they don't go up. So this would be like your interest on your debt. If sales go up, do you pay a higher interest rate? Well, if it's variable interest rate debt, possibly if the economy is strong and interest rates go up, but a lot of the debt's fixed. Does depreciation go up on your equipment if sales go up? Well, not if you're using straight line method. Does your contribution to even your pension fund go up if sales go up, and they go up because of inflation? Not necessarily if your worker hours and your wages aren't going up, but of course your wages could be. So let's just assume that's fixed. It goes up 0. So that would mean the new earnings is 102 minus 30 minus 61.2 up to 10.8 from 10, or they're up 8%. So a 2% sales growth actually resulted in 8% earnings growth. So this is a lot of operating leverage. So meaning earnings go up in a leverage fashion at a multiple of sales. And it works the same way if sales go down. Let's say sales go down 2%. So my variable cost fell 2%. Sorry, I have something goofy going on here. I need to make, excuse me, let's make this 98 here. So sales went down 2%. My variable costs went down 2%, but my fixed costs are unchanged. So 2% drop in sales leads to an 8% drop in earnings. So if we look at that, that's really what's causing the income growth to be much more volatile than the sales growth. All right. So that it's just something really important to understand as you're looking at returns of stocks and drivers of returns. But now you also notice that the profitability has been rising over time. Back here, the profitability was 8%. So 8% earnings on every dollar of sales. Okay. Now it's more like 11%. We've looked at the long-term drivers of profitability growth in a prior section, but we know that what's happened is productivity growth was higher than wage growth, which means the corporations were keeping more of that productivity growth for themselves, resulting in higher profit margins. We also know tax rates have come down over time, which has led to higher profit margins. I have another little model here, though. So margins are driven by prices, productivity, wage growth, capacity utilization, interest rates, and taxes. So what I have here for you is in gold, a little model that looks at GDP deflator, which is a measure of prices. If prices are positive and going up really high, well, then corporations will have higher sales. If they have higher sales, you would think they would have, and some of their costs are fixed, their margins, profit margins would actually rise. So if we go back to this example here, our profit margins started at 10 divided by 100, or 10%. And we put this back to our original point. So our profit margins go up when our sales go up and our costs don't all rise at the same pace. Okay, so if prices are going up, you're going to have higher sales, but you got some costs that are fixed, you would expect our profitability to rise. And then you add to that change of productivity. If our workers are way more productive and we do not have to hire as many workers to get the additional units, well, that's will make the gold go up, and that'll make our margins go up. Now, from that, we have to subtract out how much we pay them, because if we're paying our workers way more, our costs are rising, and that'll actually reduce our overall margins. So I take inflation plus the productivity, the number of units, but I subtract from that, are we paying our workers more? And then I add to that the utilization. So if I utilize my property, plant, and equipment better and get more yield out of them, more units out of them without having to add more, well, that would increase my profitability. So I add change in utilization. And of course, if interest rates are going down, so my interest on my variable rate debt and any new debt I'm issuing is going down, I have to subtract that. So if interest rates go down, that actually leads to higher profitability. So I have to do a minus. So that's the reason why this is a minus, and that helps profitability. And of course, the same thing with tax rates if they're going down. And what you'll see is this gold, when the gold goes up, that means all these things are moving in the right direction. Tax rates are going down, interest rates are going down, utilization is going higher, wages are not going up or maybe even going down. It doesn't happen that often, but at least they're not going up as quick as productivity. And we have higher prices. When the gold's going up, our profit margins tends to rise as well. When the gold goes down, profit margin goes down. So where are we recently? So margins, the model said margins should go way up coming out of COVID, and they did, okay? But now what it's actually telling us, looking at all these things together, is margins should be coming down, and they are. So in order to forecast future margins, you need to forecast the future changes of these as they relate to each other. The right-hand graph is just showing you over a long time period how profit margins have risen. And this is not just looking at the profit margins for the S&P 500 like we showed earlier, but for public-private companies, all companies. And it's the same model I have on the left for the gold. But anyway, it looks like gains after COVID are turning to margins losses right now. So let's look at a graph just looking at PE and E and price. So what you see here is the total return on the S&P 500. And this time I'm just looking at PE times E is price, and then the change in price is part of returns, and then I'm adding dividend yield. So dividend yield is in the gray. What I want you to notice on here is the change in the PE, the black, tends to matter as much as the change in the earnings, which is the goal. Turns out it actually matters more to returns. So what I've done over on the right, I looked at the change in earnings, and by the way, I'm looking at next 12 months earnings, not the latest 12 months, but what's happening in the next 12 months. If you think about this, it should be that prices respond or should reflect what's going to happen in the future. They're not that good of a forecasting mechanism because they don't forecast it too far ahead, but you can see stock returns tend to lead by a little bit earnings. So if that's the case, you would expect changes in future earnings to be more correlated with stock returns than what happened to the earnings over the last 12 months when I'm looking at what's happened to the stock returns over the last 12 months. Because stocks tend to price in the future a little bit more than the past. So when I did this is I looked at change in earnings, the next 12 months earnings, and change in price. It explains about 22% of the variability of price. But change in the PE ratio using next 12 months earnings, it explains about 61% of the change in the price. It seems like everybody's time, not everybody, but a lot of people's time is focused on what's happening to GDP, what's happened to inflation, what's happening to margins, all the way to get to what's happening with earnings. But a lot of investors underperform. Why? Because what drives return is even more than earnings, is what happens to people's expectations of earnings and risk and growth, which is quantified in this price to earnings ratio. Change in the PE matters more than even changes in the earnings to price. So what determines the PE? Well, this is the Gordon growth model, which you have learned sometime earlier in your education. The value of a stock is just the value of dividends in the future, so it's D1, so it's dividends next year, over the cost of equity capital minus the growth rate. Now, this is a ludicrous formula, meaning it's too simple. This assumes that all you get from a company is dividends. We really should be having free cash flow here. It assumes that you have the same cost of capital, R, for every one of these dividends. It assumes that a constant growth rate, which never happens. But just stay with me, and I will actually help you understand what drives a PE ratio, starting with this equation, which is a really nice starting point, but there's a lot of adjustments we would need to make. Let's expand D1 into D1 is just earnings in year one times the payout ratio. Payout is just D1 over E1. So it's how much dividends are paid as a percent of earnings. So D1 times E1 times E1 would just be the D1 here. So now let's rearrange this equation. What is the price divided by the next 12 months earnings? Well, take both sides of the equation divided by E1. And then what I have over on the right is the PE, the price we're paying for earnings, is positively related if you have a higher payout. Well, if you actually pay out more of your earnings in dividends, that's good for investors. Because I could use those dividends to go buy up more companies, my price to earnings ratio should be higher. It turns out that's assuming all else is equal. If you have a higher dividend payout, maybe you have less growth. And the higher the growth, since this is subtraction, if you have a high growth rate, the denominator down here becomes smaller, which drives up the PE ratio. So higher growth drives up PE. And then R really is something that quantifies risk. It's the required rate of return. But if you have a higher risk, you should have a higher required rate of return. A higher R makes the denominator bigger, drives down the PE ratio. So PE is a function, it actually measures people's expectations of mostly growth and risk. Over on the right, I'm showing you the PE ratio for the S&P 500 mid-sized companies and small companies in the US. You can see this back here, this is coming off an internet bubble. If I took this to 2001, you'd see it's really high. You see it was really high here too, coming out of a recession. Really high up here, really high here, and now it's, you know, if you think right now is more of a normal environment, we are late cycle. The PE ratio of the S&P 500 actually looks pretty high outside of recessions. Now, of small and mid cap, it looks a lot more attractive. So what's driving this PE ratio? Well, if this is high, then that means people's expectations of risk must be low, and or their expectations of growth is high. Does that seem consistent with today's market where everybody's worried about a recession? A recession would have low growth, and the recession would have, you know, people worried about it would be high risk. You would actually expect this PE ratio to be a lot lower. There must be more to the story, or maybe people are just pricing the market incorrectly. So, more to the story. It turns out that the PE ratio tends to be highest for the S&P 500 when trailing 12-month growth is lowest. Look at this graph here. The PE ratio, this time I'm using latest 12 months PE, tends to be really high when earnings growth, using the latest 12 months earnings growth, is low. And the PE tends to be low when earnings growth is really high. They tend to go opposite directions, at least for the S&P 500, and a lot of sectors that tend to be cyclical, meaning they go up and down a lot with the economy. So what's going on here? Well, look at this equation. When earnings growth is really, really low here, the PE is high, so PE tends to be really high when the past growth is low. What happened after this? Remember, the price should reflect the future. What happened to the growth rate after? Well, the growth rate accelerated, was really fast. So the PE reflected the fact that its future growth was going to be really high. As future growth is really high, the denominator is low, the PE is high. It also indicated that, well, when earnings were really, really low, this is the financial crisis, that current risk is high, but if the future is brighter, then the risk is going to go down, so the R was going to go down, and if you have a lower R, then you can justify a higher PE ratio. And you see the exact same thing happen. You had a high PE ratio when earnings were really low, basically during COVID. And then the PE ratio came crashing down as earnings growth went way up. Now the PE ratios come back up again. So we have kind of this inverse relationship. PE tends to be highest when earnings are lowest, because when earnings are lowest, future growth is going to be higher and future risk is going to be lower. Okay, so that's the first why. Now what I have down here is the relationship between interest rates and what's called the cyclically adjusted PE ratio, courtesy of Shiller. If we adjust the P and PE for inflation, and we adjust the E for inflation and use a 10-year average of earnings. So instead of looking at just the latest year, let's look at the 10-year average of earnings. And then a lower interest rates drive up PE, but to a point. So if interest rates go down, PE goes up. You can see that. But it seems like right here, the PE was the highest here, and it's a little bit lower here, and it seems to be something's weird's happening. Where if you go lower and lower, lower interest rate, PE rises, but doesn't necessarily, it's not really necessarily a higher PE with this low interest rate than here. So what's going on? R in this equation is a function of the risk-free rate, which is like the 10-year bond, plus an equity risk premium. When interest rates are really, really low, R is down, but when it gets extremely low, the PE doesn't rise as much. I mean, when it's, you're right here, this PE, if this relationship's like this, it should be like way up here. Why doesn't it get to way up here? Because something else is happening. This equity risk premium may be rising. So as the risk-free rate's going down, which is the 10-year bond, the ERP, the equity risk premium, may be rising and R could actually be going up. So when interest rates are really low, what's happening with the economy? The economy is in trouble, isn't it? If interest rates are low, the Fed's lowering interest rates, we're probably in a recession. If we're in a recession, do people want to buy stocks that have really volatile earnings and the earnings are probably plunging? Probably not. As a result, as rates go down and they become smaller, the PE doesn't respond higher because the ERP is going up as much as the risk-free rate's going down and R is not going down with the lower interest rates. So let's look at this ERP in a little bit more detail. I say PE is also determined by the equity risk premium. Now, R is the risk-free rate plus this equity risk premium. What I've done for you on the right is I plotted the 10-year rate in the gold. I plotted the earnings yield using Shiller's cyclically adjusted PE in black, and the equity risk premium is the gray. So the equity risk premium, all I'm doing is taking the earnings yield, which is the inverse of the PE, minus the 10-year treasury rate. I need to explain this in a little bit more detail, okay? So let me take you to a spreadsheet. Now let me help you understand what is this ERP. ERP is just the earnings yield minus the 10-year treasury rate. And a lot of people have like this shortcut way to come up with this ERP. So let's start with what we know. Price is earnings times the payout, that's dividends, times 1 plus G. All this would be D1 over R minus G. Let's divide both sides of this equation by earnings. I got PE equals payout times 1 plus G over R minus G. So I'm just going from this equation to this equation divided by both sides of the equation by earnings. Now what I'm going to do is I'm going to create an earnings yield, which is the inverse of the PE. I'm just going to flip the ratio. So instead of P over E, I'm going to do E over P. And if I do that, then I get my 1 R minus G becomes in the numerator, and my payout times 1 plus G, that just goes in the denominator. And then I can expand my R. My R is the 10-year rate plus the equity risk premium. So that's R expanded, and then subtract out the growth rate. And then what I'm going to do is I'm going to multiply both sides of this equation times payout times 1 plus G. So now I do that on the right-hand side, payout 1 plus G just drops out, and the left-hand side is E over P times payout times 1 plus G. Right, now to simplify things, let's just ignore payout and growth. A lot of people do this when they're calculating the equity risk premium. There's a way to make this adjustment that's beyond what I'm teaching right here to include the payout and growth rate. And if you do that, you may get a little bit different answer than what we're going to show you. But if you ignore the payout and you ignore the growth rate, then payout and the growth rates all drop out of the equation. You get E over P equals 10-year rate plus the equity risk premium. So the equity risk premium is the extra yield on stocks, the earnings divided by price, above the return if they had no risk. Stocks have risk. So the ERP, doing these adjustments, tells you how much extra If all your earnings were paid out in a dividend, do you get from stocks versus what you get from the risk-free bond, the 10-year bond? If this ERP is low, that must mean the price of the stock's high, because if the price goes up, the E over P becomes low. And if so ERP is low, that means you're not getting much extra return from stocks versus the risk-free rate, and that's a bad deal, especially if you're worried about a recession. So let's go back to the slides. So if you look at over time, this, the equity risk premium, the earnings yield minus the 10-year treasury rate is practically zero. That means stocks are not yielding much more than the 10-year bond. That implies stocks are really expensive. That implies stocks are not pricing in much risk, and they're pricing in a lot of growth. Now, I have a question for you. Over the last 88 years, stocks have always had positive 15-year returns. Basically, I looked at 88 years of stock returns, and how many, over the last 88 years, for every month, I had a 15-year history. I had 876 15-year history of returns over the last 88 years. What percent of those 15-year histories, rolling back, were stock returns positive? 876 of 876, 100% of the time. So some people said, well, you can justify a low equity risk premium, low extra yield for stocks over bonds because they always return positive if you have a long horizon. That type of logic got people in trouble around the internet bubble. Sorry, where's the internet bubble? Well, let's ignore the internet bubble, all right? It wasn't the example I wanted to show you. But using a little bit different, not the CAPE, but using a different equity risk premium where we're just looking at the actual PE ratio, not a 10-year average, and not this cyclically adjusted one, is adjusting for a bunch of different variables here. The earnings yield of the market during the internet bubble relative to the 10-year rate was also really low, and people use the logic, stocks don't have more risk than bonds, so you shouldn't have this extra earnings yield. So if the earnings yield shouldn't be greater than the 10-year treasury, that could justify a really high P. Let's go back to the spreadsheet. I just want to make sure you understand this. During the internet bubble, this became close to zero. And they said that was justified because returns are always positive if you have a longer horizon. The E to P was extremely low during the internet bubble, which means the PE ratio was extremely high. That's the type of logic that got people justifying a really high PE ratio. How did that work out for them? Well, the bubble burst and the market fell apart. We don't live on average returns. This is the market on, the average stock in the market had positive returns over every 15-year period over the last 88 years, but you may not own the market. You may own individual stocks. You may buy or sell stocks at different periods of time when the stocks are high and then they go down. It turns out we don't live on the average. And if you look up here, the S&P 500 as SPX had 8.88% returns over this period of time, but their standard deviation returns was 16.7%. Much more volatile than U.S. government bond returns. U.S. government bond returns had 2.64% annualized return, but only 5.7% volatility, less, about a third of the market. Stocks are more volatile than bonds, and that volatility, since we don't live on average returns, is you need to be compensated. And you should be compensated at a level sufficiently above the 10-year treasury. And right now it looks like we're not being compensated much and stocks are expensive. How does this earnings yield go up and this ERP rise? Well, in order for it to rise, price must fall. So if price falls, the ERP goes up. Also, the 10-year bond could fall, all right? But if the 10-year bond falls, that's probably because we're in a recession. What happens to E? E goes down. So it seems to be that the stock market appears to be kind of expensive. Maybe it's all that liquidity that the Fed provided during COVID. Now the liquidity is starting to go back the other way, but people are just willing to continue putting their money in the stock market. So let's look at a different way to look at the PE ratio. You can have a proxy for the equity risk premium as confidence. If you have higher confidence, you should have a lower equity risk premium. If you have a lower equity risk premium, you should have a lower R. If you have a lower R, you should have a higher PE ratio. So what I have here is the University of Michigan Sentiment Index. And as sentiment goes up, the equity risk premium should go down. If that's the case, R should go down and PE should go up. You see there's a positive relationship. At the moment, the survey has the Michigan sentiments come down and you still have a pretty high PE. It's not as high as it has been over this period of time, but it still looks a little bit lofty, okay, relative to the level of sentiment, which is equity risk premium and sentiment kind of go together, all right? Meaning lower sentiment, higher ERP. All right, so that's PE. It makes sense that price would also, if PE times E is price, it would make sense that the S&P 500 returns should move with earnings revisions. So if earnings are being revised down, I would expect the S&P 500 returns to be lower. And that's what you're seeing. I have something called revision breadth. All I'm doing is looking at the number of companies where analysts are revising up their earnings estimate. So let's say the earnings estimate were $1 the latest quarter, but now they revise it up to $1.50. That would be an upward revision. And if earnings were expected to be $1 and they revise it down to 80 cents, that's a downward revision. So I'm looking at the number of upward revisions minus the number of downward revisions divided by the total number of revisions. So if revisions of earnings estimates are up, you would expect returns to be positive, because if revisions are up, the E in the PE times E is rising. And you see it's very highly correlated. Earnings revisions have been revised down here recently, and stock returns have responded negative. Let's look at dividends. So we know it's PE times E is price, and price change is part of the capital gains part of the returns. But we also have adding dividend yield in the end. And it's interesting that high dividend yield companies tend to outperform. Let's go back to our equation. Let's just move back and make sure you understand this. Right? All this part of the equation gets you to what's happening with the capital gains part of the return. Then you have to add in dividend yield. Dividend yield is 2% of all the returns here, okay? So let's look at dividends just a little bit closer. It turns out that companies with a high dividend yield, this is a study I did in international small cap stocks, but I've done this for US large cap, and I've done this for basically the same results you see here kind of apply to the overall markets. So if I looked at companies with a high dividend yield, that's the ones, and I look at companies with low dividend yields, the high dividend yield companies have a higher returns than the low dividend yield companies. The median yield was close to 5%. The median yield here was about 1%. And if you look at, did you have no dividends? Well, that was 2, approximately the same as the low dividend yield companies. So why does a high dividend yield companies outperform? Well, you say, well, coach, they outperform because it's part of your equation, is, price return, PE times E plus dividend yield. Sure, that is actually one reason why high dividend yield companies outperform. But if you're paying a really high dividend yield, that means your payout ratio is high. And if your payout ratio is high, that means you're not reinvesting as much in the company for growth. If you're not reinvesting as much for growth, then that earnings part of the equation, the PE times E, the E should be going up slower. Or does it? I've come to the conclusion that companies that pay a high dividend yield, part of it's the equation. You have higher dividends. And by the way, another reason why, there's 3 reasons I think that really drives high dividend yield. I'm going to back up a little bit. One is you get high dividends, so it's part of my return from investments. A high dividend yield also means low price. So if you have low price, it's like buying a low PE company, and the low priced earnings, price to book, price to cash flow companies tend to outperform over time because they have low expectations, and if they beat the expectations, they outperform. So it could be that they have a low price and there's reversion that happens and companies are doing poorly, outperform over time. It could be that it has high dividend yield, so high dividends, that's leading to the outperformance. But the third one I think is also really important. The companies that pay out a lot of dividends, which means they're not investing as much for growth, they have discipline. If you pay out a high dividend, and if I ever cut the dividend, then I'm going to be fired as a manager, they're going to be less likely to make acquisitions at peaks of cycles at really high prices. They're going to be less likely to basically do things that hurt them. Spend lots of money on expanding capacity at the peak, because anyone paying a high dividend knows you never want to cut it, because if you cut it, you're going to lose your job. The stock's going to go way down. So they're very, very careful when they're using the cash flow that the company produces when they're considering new growth expenditures, buying other companies and expanding their property, plant, and equipment, because they never want to do that if the demand in the future for whatever they're going to use that property, plant, and equipment for is not going to be there. So they're very cautious, and that cautious could lead them to not doing value destructive acquisitions and capital spendings at peaks of cycles. And I will show you that's what on average corporate managers do in a later section. So what drives equity returns? Let's just put this all onto a model. So what the dependent variable in the model is S&P 500. And then using these same economic variables we did earlier, I created a multi-factor regression. So my dependent variable is S&P 500. I have an intercept. I have factors 1 through factor K. These are the different factors. And then I have betas to each one of these. The coefficients are the betas, and the p-values over here show you statistical significance. My R squared of my model is 0.82, meaning 82% of the variability of the S&P 500 are explained by these factors with these different ways. So when are stock returns higher? Well, this is a positive coefficient, so that's the first one. That's when consumer confidence is higher. Doesn't surprise me if consumer confidence is higher. Well, that's probably when unemployment rate is low. as I showed you earlier. Well, if unemployment's rate low and confidence high, you're probably going to have a lot of spending. If there's a lot of spending, that's a lot of sales for the S&P 500 companies. Oh, it's also market returns are high when wages are going up. Well, if people have more wages, they're going to spend more. There's going to be more sales for the S&P 500. Hey, earnings are going to go up. When industrial production is higher, S&P 500 returns are higher. That makes sense. If you're producing more, the economy is good, earnings are good, the market returns are high. You see this negative relationship with the dollar again. When S&P returns are high, that's the risk on asset, the dollar tends to be going down, and so on and so on. So the relationships we would expect that drive the S&P 500 up based on the economy tend to exist, okay? The relationships do change over time, okay? So I'm just showing you the change over the whole period, unless the more latest, it looks like 10 years. So our coefficients do change over time. Now this is using the S&P 500 as the dependent variable. And you see there's a negative relationship with unemployment. So when unemployment rate goes down, the S&P 500 returns tend to be high. So it's a negative coefficient, okay? So that's for the S&P 500. Let's look at what it is for bonds. It turns out, if I make my dependent variable US government bonds, the unemployment rate, when the unemployment rate's higher, bond returns tend to be high. But when the unemployment rate is lower, stock returns tend to be high. It's a flipped ratio for stocks versus bonds. Well, remember, stocks are like a risk-on asset. So when unemployment rate goes down, there's more spending, stocks go up. And by the way, they go up because someone may sell their safe government bonds to buy stocks. And when the unemployment rate goes up, stocks go down. Well, they're selling the stocks. And what do they buy? Did they sit it in cash? Not maybe, but more than likely they buy it in US government bonds, the safe assets, and that pushes up bond prices and it pushes down the yield. And so you have exactly opposite relationship. Let's take a little bit more look at sector weights. So we've been talking about the S&P 500, and this is using middle 2022 weights, and these are percentages of the S&P 500. But we got value stocks and we got growth stocks. Value universe tends to have much less in technology, 11 versus 44. Value universe, value meaning cheaper companies with lower growth rates, tend to have more maybe a mature sector, consumer staples, 11 versus 2 or 12 versus 2. More in cyclical sectors, more in energy, 7 versus 1. Looks like 15 versus 7. It does have a little bit more in some defensive or industries or sectors that don't go up and down as much because we need them, like healthcare and also utilities. But generally, value tends to have less in technology, really growthy, which can also be cyclical, and more in the cyclical sectors. So if you look at sector returns of the S&P 500, the world's divided into now 11 sectors. Now, I don't have as much history for real estate, so I'm excluding that one. But this is consumer discretionary. This would be like retail, consumer stuff that you don't need to get, like go out to a restaurant, find new clothing. Consumer staples, that'd be like food, beverage, things that you need to have that are consumers to survive. Energy, that's oil. Financials, banking, healthcare, very stable, maybe some growth elements. Industrials, These are ones making the property, plant, and equipment, making the machinery to mine equipment. IT, that's technology, materials. So this is commodities, excluding energy. So that'd be aluminum, copper, etc. Telecom, so that's communication, and then utilities. Now, utilities is like your natural gas for your house and electricity. If you look at this, it looks crazy. There's some years where oil does really well, have highest return. These are annual returns, and some years it's horrible, and then it's years it's great. Every single sector seems to have one where it's dark red, meaning bad returns, and dark green where it's the best returns. You sit here and look at this, you'd say, what the heck is going on? This is just random. I give up. It turns out it's not random. Let's take a look over here. So IT had the highest return over this annualized return, but also the highest standard deviation. The Sharpe ratio is just this return minus the risk-free rate. I just used 3%. Could have been 2, could have been 4 for each one of these. And I take this as a percent of the standard deviation. So a reasonably good risk-adjusted returns. You want higher return and you want lower volatility. So IT had the highest return, but nearly as highest volatility. So 24.7 is almost the highest volatility. So it kind of gives you a mediocre. The consumer staples had, kind of a moderate return, but really low volatility. That food and beverage, hey, those businesses don't go up and down that much. So it had actually the best Sharpe ratio. So what determines these returns? Because this looks pretty random here. Well, the economy does. So if we segment the sectors into what we call defensives that don't go up and down much with the economy, they're pretty stable. So they're pretty stable. And then we do cyclical, where they go way up and way down with the economy. And then correlate that with the economy, you'll actually see cyclicals tend to be much more volatile. Their stocks with the economy than defensives. So defensives, I say, is consumer staples, utilities. I mean, we need food and beverage. We need, heat. And telecom, I think most people are not willing to give her their cell phone. If they break a leg, you probably go into the doctor, so that's healthcare. And real estate, some people think of it as cyclical because housing goes up and down, but if you invest in real estate, you get a stable monthly income. So some people think of it as defensive. So I could have put this in one of either area, cyclical or defensive. It has both attributes. But let's say we have defensives here and cyclicals, consumer discretionary. If I lose my job because it's a recession, I'm probably not going out to eat. If I lose my job, I'm probably not going on a vacation, so I'm not filling up my car with gas. And if I'm not going out to work, I'm not filling up my car with gas, so energy goes down. Financials, well, if I lose my job, I may default on my debt, and I'm definitely, so financials may not do well. And if the economy is not doing well, these industrial companies that make more plant and equipment to grow businesses and replace it, probably businesses, since they're hurting because more people are out of work, they're probably not upgrading their equipment. Materials go down because, I'm not buying new cars with that aluminum, so material prices go down. IT, it can have some growth elements to it, but I would also argue it's cyclical because if the economy is not doing well, I'm probably not updating my computers. Now, COVID was different because we all moved online, and when the economy didn't do well, IT did well, but that was kind of an aberration. Normally, this is a cyclical sector. So what I've done is I divided the world into whether your PMI is greater than 48. If you go to the Institute of Supply Chain Management's website, they point out that if the PMI, the manufacturing PMI, is less than 48, normally the economy is in a recession. So I looked at sector returns. All these represent sector returns. If the PMI is above 48, and I also looked at is the PMI rising. So this is the PMI is rising. This is the PMI is above 48, but falling. It's actually, it may be 52, but it was 60. That would be falling. And then I also looked at inflation. And I did a 2% cutoff for inflation because that's the Fed's target. So if inflation is running really hot, we're probably PMI is high and we're late in the cycle, we're way up here. And I looked at when do these defensive and cyclical sectors perform well? And what you notice, this is best assets and this is worst assets depending on the cycle here, okay? When the economy, let's just take the economy is strong, so PMI is high and it's accelerating. What does best? Financials, IT, energy, materials, industrials, all the cyclical. What does worse? The returns are still positive, but way less positive than these. Consumer staples, the safe one. Utilities, the safe one. Telecom, the safe one. Healthcare is the safe one. These are all the worst assets when times are really great. Now let's go back to when times are bad. So the PMI is less than 48, it's declining, and things are bad, okay? What's the worst assets? Cyclical, financials. Banks are probably, trading volumes down, so that's not doing well. Of course, corporations acquire fewer companies when prices are low, which is the wrong thing, but that's what happens. So banks, the investment banks aren't doing well with that. Of course, if people are losing job, they're declaring bankruptcy, not paying on their debts. So financials don't do very well when the economy is basically recession and it's getting worse. Energy doesn't do well. Industrials doesn't do well. These are the worst sectors. What's the best ones? Well, the best ones still have negative returns, but once again, consumer staples. We need this. So even though the economy is not doing well, we're still going to go out and buy food and beverage. We still go to the doctor if we break our leg. No one wants to give up their phone, okay? So if you understand where the economy is going, you can understand where to pick sectors, okay? Now, go back to the growth versus value. You also understand when to be in maybe value versus growth, because value tends to be a little bit more cyclical than the growth universe. So you can use the same thing to figure out whether you want to be in value or growth stocks. It turns out, and we will talk way more of this when we talk about factor rotations, but one of the things that drives value and growth factor rotations is the economy, which I actually have here. There's other things too, but the economy is a big one. So generally, when the economy is weakening, the defensive or the growthier ones tend to outperform here. And when the economy is doing this, more value tends to do well. Okay, so let's just put the PMI and with cyclicals versus defensive sectors. Same thing I did here, but I just created a composite of defensives, composite of cyclicals, and I'm just looking at the PMI. Well, exactly what you expect. If PMI is going up, the cyclicals, the black, relative to the defensives, tend to rise. Okay? Now, recently, the cyclicals have been rising relative to defenses, even though the PMI is falling off the face of the earth. That would tell you that there's some disagreement on what's going on. And maybe the market is expecting the economy to rebound, which could also explain why that equity risk premium is really low, because they're not pricing in necessarily fully risk of recession, risk of earnings going down. And so this is really at odds. And possibly a lot of people have lots of cash and they don't know what else to do with it at the moment. Just to prove to you, why does cyclicals tend to do better when the economy is doing better? On the right-hand side, I have the cyclical sectors. On the left-hand side, I have kind of the defensive sectors. And then the gold, the shaded gold, is S&P 500 earnings growth. And what you can see is the more defensive sectors, consumer staples, telecom, this time I put real estate in here, healthcare and utilities, their earnings, and I'm using the same scale on both of them, they kind of go up and down, sometimes even up and down less than the overall S&P 500, but almost without exception, all these cyclical sectors, energy, industrials, materials, consumer discretionary, financials, and technology, their earnings tend to go up and down in an exaggerated fashion. So that would tell you why you see this, that when times are good and they're getting better, so the economy is strong and it's growing really quickly, the cyclicals tend to do better than the defensives, because when the times are good, the cyclicals earnings are going up way more than the defensives. Okay, let's look at one example and put all this together: earnings growth, revisions, and PE. We'll just do this with industrials. We could have done this with any sector, but industrials tends to be a more cyclical. What I'm showing you is, in the black, is industrials performance relative to market. So if this is like going from 100 to 115, that means industrials stocks went up 15% more than the S&P 500. It tends to be somewhat correlated with how does their latest 12 months earnings do relative to the market. So if earnings are going up quicker than the market, you would expect the price to go up quicker than the market. Now, remember, there's PE ratios that impact this as well. So it's E times PE. Now, let's look at revisions. So if the market tends to respond, at least industrials, the relative returns, the returns rise a little bit in anticipation of the revisions being more positive for industrials than the overall market. And the market I'm using here is the S&P 500, okay? Recently, the revision breadth for industrials is very high, and that helps explain why it's outperforming. The price has been going up because its earnings have also been going up. Now that's the earnings part of the PE times E, E's price equation. Let's look at PE. Now this time I'm not doing relative, I'm actually just doing earnings per share growth and PE, and you see it's inverse related again. So PE tends to be the highest for industrial when earnings are lowest. The market's learned over time, if earnings are low, that means the economy is doing bad, but if the economy is doing bad, the Fed will lower interest rates. Eventually the economy will do good, people will be expanding capacity. I'm going to pay a high PE for this low earnings because I know earnings are going to turn around. Now recently the PE has been going up as the earnings growth has been slowing. So cyclical sectors, you'll see this negative relationship between PE and E. If I would have thrown consumer staples on here, since it's not that cyclical, it's a defensive sector, you may have seen a different relationship, okay? Last thing, what's happening right now to revisions? So I'm looking at the estimate revisions for 2023 and 2024 for every sector of the market. And if it starts at 100, back last June, and you're down here at 80, that means the earnings expectations have declined as people were expecting, lower growth. Now, normally earnings expectations do decline. We normally start positive and it goes down. The only exception is energy. They've been revising up expectations, but the expectations stopped being revised up someplace around November in 2022. Normally when estimate revisions come down, the market responds to that, and it has, with lower returns. That's it. I hope you learned a lot about building up to GDP growth, to returns. Well, I hope you learned a lot, and this will be valuable to you in your investing in the future. Have a great day.